Everyone, and thank you very much for joining us today with another educational opportunity brought to you by the New York Stock Exchange in partnership with ETF Central. I'm Douglas Jonas. I'm the head of exchange traded products here at the New York Stock Exchange. I'm going to be hosting what is a very exciting event. Now, first and foremost, I want to offer a big welcome to all the certified ETF advisors, the CETF designation, the advisors who are joining us here today. As a reminder, that CETF designation is the newest FINRA designation for advisors and practitioners, all dedicated to the ETF industry, and it's available on etfcentral.com. You just go to ETF Central and click on the ETF Institute at the top bar. That'll take you on the screen directly to all the information you need to become a CETF. Now, in today's webcast, we're going to be bringing together market leaders for you so that you and your business can benefit by hearing directly from the experts. Now, today's webcast is focused on 2024. We're going to talk through the current state of the Fed, monetary policy, and geopolitical events. But more importantly, we're going to talk about where opportunities exist in today's capital markets. Now, for those listening in live, thank you for being here. We are taking live questions. So I'm inviting you to send them in via the platform in front of you. They will come directly to me on my monitor. I'm going to do my best to kind of insert them through our conversation and bring them directly to the panelists throughout the event. Now, with that, I am joined today by Meera Pandit. She's Global Market Strategist at JPMorgan. David Jones, Director of iShares Investment Strategy and Markets Coverage at BlackRock. And Matthew Bartolini, he's MD at State Street Global Advisors and Head of America's Research at Spider. You can find some of their bios in the bio widget at the lower part of the screen, but more importantly, you can find them on social media, LinkedIn, like them, follow them, and you'll see them, of course, on TV. Let's begin. Okay, Matt, I want to go right into it. We have to start with the Fed. I want to talk about this week, the news that came out, right, real time in the middle of it, and how this potential for rate cuts in 2024 is really driving our markets to record highs. So what should we expect from the Fed, and I guess subsequently the equity markets as we start to head into the next quarter, the full year? You know, what does the run-up in tech mean? We're going to take it everywhere. So let's start there.
Yeah, I mean, I think yesterday, right, Chair Powell pretty much threw cold water on the idea that there's going to be a March rate cut. I mean, basically even saying that the committee will pretty much unlikely to reach full confidence by that meeting. But that doesn't mean that March is a meeting to be inconsequential. I actually think it's probably going to be one of the more important meetings for monetary policy this year, for the reasons that it's going to provide some more clarity on what their actual path and pace might be. Because for starters, March is actually 2 years to the meeting when they first started hiking rates aggressively. And there has been a lot of Federal Reserve research from Raphael Bostic, for one, saying that there's usually a 2-year lag for monetary policy to take in full effect. So 2 years, I mean, that's more of a calendar quirk than anything else right now, but it does sort of line up from that research perspective. I think for me, what I'm looking for in March is where we get a little more softening or dovishness in the language. Pretty much something we also saw in July of 2019, right before they started to cut rates then, where you see some language around the Federal Reserve Committee maybe acting appropriately to sustain the expansion while monitoring economic growth and labor trends. If that does come into the language in the March meeting, that means May, June is almost like 100% live meeting to go from that perspective. I think, what we saw is that, when Powell threw some cold water on it yesterday, there was a re-rating of expectations. So if those re-rating of expectations continue to occur, that's likely to sort of spur some near-term volatility because the market is expecting 6 rate cuts right now. And I think that's probably too much. We'll likely end up in this sort of 3 to 4 range. I don't see them actually changing monetary policy that significantly around the fall when you have a lot of election-related volatility impacting market sentiment. I think they'll probably try to front-load some of those cuts. So that's why that May, June, July meetings are really important. But there's going to be a re-rating of expectations. And you go from 6 to 4, the market's not going to like that. And I think that's why you will see some of that volatility. We saw that yesterday. But in the end of the day, there's still going to be rate cuts. And I think when the year's over, the market will like that. Lower financing rates at the same time where broad-based growth, both economically and fundamentally, are going to be positive. And U.S. expectations for earnings growth right now is double digits. I think the biggest concern is around market concentration. The concentrated nature of market returns has the ability to sort of lead to weaker breadth. And right now, it kind of makes sense why those firms are leading. They make up the majority of earnings growth. The big thing is, though, by the time Q2, Q3 comes around, the X Mag 7 of the S&P 500 will actually start to be having earnings growth higher than the Mag 7. Some of that's due to base effects. But you throw in that with lower rates, I think that sets up a pretty good market for cyclical industries, maybe small cap, maybe value. Industries really tied to the consumer, like home builders. So, the Fed is definitely something to watch. Rate cuts are on the horizon, not the ones that you're expecting right now. March is not a live meeting. Look for the language. May, June is probably the first time we actually see some rate cuts.
Thank you. And by the way, we're already getting questions in from the audience. Thank you. Keep them coming. Meera, if I could slide over to you, could you tell us a little bit about, I don't know, put the JPMorgan lens on this. What are you thinking about for 2024? Do you have expectations? And if you wouldn't mind, maybe start to touch on some of the, evolving geopolitical risks that are out there in the markets today.
So our outlook for 2024 actually can be kind of neatly summed up into the number 2024. So we anticipate for the economy 2% real GDP growth, 0 recessions, 2% inflation by the end of the year, and about 4% unemployment, or perhaps slightly below that for the year as well. If we think about what makes that up, 2% real GDP growth, look, we've been growing for 6 consecutive quarters at this point above trend, because usually we grow at around 2%. So we're likely to see the economy slow a bit, but again, because we're starting off of such a strong base, likely slowing back to trend. And when we think about our models for the year, we think about all the different components of GDP and how to get to that negative number to see a recession, we just don't see it with the data that we have right now that it's going to cause a full-blown recession. So given that it's a more normal economy without a recession this year, and part of that is that 4% when we think about unemployment spending at this point, the longest stretch of time at or below 4% since the late 1960s. So not only has unemployment been low, which we shouldn't take for granted, but it has been stable, which I think is really the key point there. People have jobs, the worker is the consumer is the worker. That helps fuel consumption, which is 2/3 of our economy, and that supports growth overall. And then maybe a little bit more controversial, because some people think inflation's a little bit sticky, but we do see inflation getting back to the Fed's 2% target, because about 80% of what is left of inflation at this point is rents and auto insurance. So it's not broad-based, it's very concentrated at this point. And both of those things, rents and auto insurance, are really measures that look at averages as opposed to what's actually happening today. So they tend to be lagging in nature. So we do think we're going to creep towards that 2% target by the end of the year. If you look at some of the more recent measures of all of the major inflation measures, and you look at that 3-month annualized trend, essentially we're there by many measures or below 2%. So I think all of this gives the Fed ammunition to cut. Now, if you think about earnings on the other side too, expectations after a potentially a flat year in earnings in 2023 are about 11%. We do think that's a little bit optimistic, but even if you get half of that, you pair a benign economy with profit growth, and you get a pretty constructive environment for equities. Now, the geopolitical situation clearly has people a little bit concerned about whether that's going to cause volatility. Certainly to some extent it will, because we had a very low volatility year in the equity market last year, even though the bond market was quite volatile. So our expectation is, look, we have to see the signal through the noise. Think about with these geopolitical events, as typically tragic and upsetting as they are, what is the transmission mechanism to the markets in terms of GDP and weight in some of the indexes? What is the transmission mechanism when we think about inflation? Right now, we've seen things like oil prices and supply chain creep up a little bit, but nothing worrying like we saw in 2022. And what we saw in 2022 is eventually those spikes reversed themselves. So I don't think we want to get too wound up about some of the geopolitical events when we think about markets in particular, human tragedy and political tragedy aside.
David, I want to get you into the conversation. If I could come to you, could you share a little bit about what iShares, what are you speaking with your clients right now, your advisors, your institutions? Do you have expectations as we start to look a little bit more forward into 2024?
Yeah, I mean, I think the number one thing that we hear from our clients and the number one thing that we discuss with our clients is that now is the time to get out of cash. We had $1.3 trillion of inflows into money market funds in 2023, and it took the assets under management of money market funds up to almost $6 trillion. That's a record. And anecdotally, when you talk to people, whether that's retail folks with RIAs or more sophisticated institutional people or even hedge funds, everybody tells us, or nearly everybody tells us, that they are basically overweight cash. And our message to them is now is the time to deploy that cash, right? I think, our panelists, Matthew and Meera, put it very succinctly that the Fed is most likely going to cut this year, not by as much as, the market has priced in, of course, and maybe a little later than, the March time period that a lot of people were hoping for. But the next move for the Fed is probably a cut. And if you look back over history, take it all the way back to the mid-90s and look at when the best returns were realized by investors, it was the period between the last hike and the first cut. I'm sorry, the other way around. The last hike and the first cut. So that's that time period when the Fed is on pause, right? That's the time period that you want to reallocate out of cash and into fixed income. And the reason is, of course, that markets are forward looking, right? So by the time you get to the period when the first rate cut is about to happen, that's already priced into the bond market, and that those sort of gains have already been realized. So what we've been telling people is get out of cash. You want to go further out the curve. We like the 3 to 7 year part of the curve, and we like to be up in quality because we do foresee a slowdown in growth in the second half of the year. As far as equity goes, things look, rather richly valued at the moment. So, for us, like looking at equities, we're like, well, the index itself is probably not where you want to be on a broad basis. What you want to look for are what we're calling the lovable laggards, right? These are sort of the sectors, the industries that really haven't participated in the rally, but share a lot of the characteristics with sort of the high-flying technology stocks. So, look for sectors and industries that have good free cash flow, that have low operating leverage, that have, low variability in earnings growth. And what you find, this is really the quality characteristics. So, we're looking at things that have that quality. We're also looking at sectors like, the financials. We think, for instance, very large banks and exchanges are going to do well this year as you get sort of a steeper curve, lower rates. And there's probably going to be a lot of investment banking business coming through this year. A lot of this investment banking business is funded in sort of the short term, right, through the leveraged loans. So that's a 3-month floating rate. And with the, when the Fed was raising rates, that meant that a lot of these deals became very, very unattractive. So there is a backup now in sort of investment banking business, whether that's, secondary issuance, whether that's, investment grade bond issuance, whether it is also just, LBO or M&A activity. We think that's really going to be to the benefit of the large broker dealers in particular.
Thanks, David. So for my colleagues, you heard it here first. David is calling this is the year for IPOs. Meera, if I could come back to you for a moment. It seems like the headlines around inflation, I don't know, they've subsided a little bit anyway. But increasingly, there's a lot of conversation and I guess a belief that the Fed has really achieved their soft landing goal. Does JPMorgan, do you buy into that narrative? And how would you sort of rate cuts when it comes to the 2024 impact in the bond markets?
The Fed doesn't want to declare victory yet. And they said, we won't acknowledge that there's been a soft landing yet. They're being cautious about that. But again, based on our 2024 outlook, we do think that inflation is getting back to 2%. And we do think that growth can still be maintained in that environment. It's interesting. We thought we were going to go through this paradigm shift where all of a sudden sticky growth meant sticky inflation, which was not the case over the last 10 or 15 years where you could have pretty good growth but low inflation. But the question is that the case or not? Now, if we think about what the Fed is going to do, I would agree with both Matt and David that essentially it's going to be less and later on Fed cuts, but it's really a question of when, not if. So I would agree with what Matt had said earlier, that probably 3 or 4 cuts this year, and probably that first cut not starting till May or June. But it's less about what the Fed then does if we know they're going to cut, but about what the market expectations are relative to the Fed. Because when you see a day like yesterday, or even kind of coming into the year where the Fed and the markets were so far apart, that difference in expectation is really what creates volatility. So we hope to see, as the year progresses, those expectations become a little bit more aligned, because that should help with some of the bond market volatility. And then in terms of what that means from a yield perspective, look, we saw basically 110 basis point drop in yields in the last 2 months or so of last year. So if we had to write an outlook in October, we probably would have anticipated that yields would end 2024 closer to 4%. Now that the Fed has acknowledged that they're going to cut, we do anticipate that yields will drift lower. They'll probably spend the first half of the year range bound between maybe 375 to 425 on the 10-year, could drift a little bit lower than that as the Fed does start to cut. But I think where we're positioned from a bond perspective is, look, at this point in time, with some degree of rate uncertainty and an inverted yield curve, having a bit of short duration, kind of 2 to 3 year, but then also barbelling that with kind of a 5 to 7 year, will potentially benefit, because I don't think that yields and the 10-year are really priced for 2% growth or 2% inflation yet. So I do imagine the direction of travel generally for yields is a little bit lower. But again, as a bond investor, it's going to be really about income this year, as opposed to expecting a massive fall in yields and some capital appreciation. But at the same time, if we think about a couple of years out, we have a lot more protection in the bond market than we have in a very long time. So I think from that standpoint, owning those bonds for a rainy day, particularly on the duration side, is important.
Matt, I want to come over to you for a bit. If you start to think about the bond markets, how should an advisor be thinking about their allocations to fixed income right now? And are there any events that you start to think of? There's one thing, there's the allocations for expectations, but sometimes there's just events in the market that we don't foresee, whether it be AI, geopolitical, I don't know, the election cycle. Are there things that could happen that would maybe change your opinion on where advisors should be right now?
Yeah, I mean, I think even just like you mentioned the election, we've done some research on this in terms of just even the equity market of like, clearly it creates some uncertainty and there's headlines, but historically S&P 500 return patterns based on party-based views are random, right? There's actually no consistent pattern between when the stock market does better under which party. It does create near-term volatility, but that quickly subsides. For those that were thinking of trying to go all in or all out during election years, if you had done that since basically the 1940s, you would have underperformed someone that was always in by about 10,000%. But obviously, clearly, elections can create some near-term dispersion based on policy decisions, whether it's healthcare, aerospace and defense. So obviously, it's top of mind, but the long-term investor should just stay invested around elections. I don't think you should be making massive changes on your strategic asset allocation just because it's an election year. That historically wealth destroying from a long-term perspective. I think within the bond space, there's been a lot of sort of consistent comments already around just moving up a little bit in duration. All of that money that did plow into ultra short duration government bond ETFs, as well as money market funds. The building portfolios in 2022 and 2023 for fixed income was sort of like this idea of T-bill and chill. You sort of could earn that 5% yield. And, again, my compliance team will probably never let me guarantee performance, but I can pretty much say if the Fed's going to cut rates at least 4 times, that the return on the T-bill over the next 12 months will be assuredly lower than the prior 12 months, right? So you're going to have reinvestment risk, moving up in duration, that 2 to 3 year spot, owning some mortgages. I think mortgages is a really fascinating sector of the marketplace right now. 2023, because of the aggressive Fed rate hikes, you had massive extension risk within mortgages. You had duration at all-time highs. And so what has happened now, right? The Fed has started to signal a more dovish tone. Mortgage rates have started to come in. You started to see mortgage-backed securities outperform treasuries by 180 basis points over the past 3 months. From a fund flow perspective, we started to see flows go into mortgage-backed ETFs as well. I think mortgages is an area where you can be a little defensive, right? Because it does have that implicit guarantee from the federal government. But you can pick up a better yield over treasuries. You can get some of that duration-induced price declines because it's going to come in based on what we see from rates. So we do like mortgages. We like being active in mortgages. We like active management in fixed income because one of the biggest trends in 2023, and it's going to carry over to 2024, given the evolution of monetary policies, is that realized volatility on core bonds is going to remain elevated. So a rolling standard deviation of 90-day returns on the Bloomberg Aggregate Bond Index was in the 90th percentile historically every single day in 2023. That's likely to continue in 2024. We think that elevated level of volatility, sector dispersion of returns, value opportunities in some of the bond sectors leads towards active management, both within traditional but also non-traditional bonds, because credit, some of those risks are asymmetrical right now. You have spreads trading in the 200 basis point range. That doesn't mean that there's going to be negative returns. It just means that you're unlikely to get the returns we saw last year, where so much was from spread compression, and judicious active management can sort of navigate those valuation concerns. So we like mortgages, we like being active, we like taking some risk within credit, because under this soft landing scenario, you're earning 7% from a coupon and the market's going to be well behaved.
Okay, it's time for one of my favorite parts of the webinar, which is the ETF roundtable question. So I want to dig into ETFs for a minute here, and I want to ask this question. What is your best idea for an ETF, given the if it all comes to true that we get a rate cut outlook and a soft landing? So I want to start with you, David.
Yeah, so I think the mortgages, and in particular our ETF for that is MBB, which tracks the U.S. MBS index. I think that's one of our favorite ones for many of the reasons that Matthew just discussed. We do think, first of all, that the duration of this of that index is in that 3 to 7 year bucket, which is what we think is really the sweet spot. The trade-off between duration and current yield, given the shape of the term structure of the yield curve at the moment. The other thing that, if there's one thing where I do slightly disagree with Matthew about is, about the prospects for fixed income volatility. As he did say, it is at a very elevated level. We actually look for it to maybe come down a little bit, a little off of these sort of very extreme levels that the fixed income volatility is now from a historical perspective. And we actually think that's going to be helpful in compressing the MBS spread. There is a very good correlation between mortgage-backed security spreads and fixed income volatility, and a lot of that has to do with the prepay option within a mortgage. So if fixed income volatility does come down, and we think that will happen probably because there's going to be more clarity about the course of short-term rates with the Federal Reserve. After these next couple of meetings, we think that clarity is going to become more apparent. And so we think that's going to help compress fixed income volatility and bring those spreads down. So mortgage-backed securities get the benefit not only from lower rates, but also from more narrow spreads. And so that's one of our favorite bets is MBB.
Thank you. Meera, I want to come to you. Assuming a rate cut outlook as well as a soft landing, investment opportunities you would focus on?
I would reiterate what David said earlier, which is essentially what you tend to see over the last six or so Fed hiking cycles back since the Fed really used interest rates as their primary monetary policy tool. You have seen after that last hike, both stocks and bonds doing pretty well in the next 12 to 18 months. So what I would say is we're in a market where you don't have to pick sides. You don't have to pick favorites here. I'd mentioned from a bond perspective, barbelling a bit between short duration as rates come down and as income is still high at this point, but also having a little bit of duration for that, again, rainy day, a bit of protection, which we're getting a lot of in bonds that we haven't in a while. And then on the equity side, we're still gearing a little bit more towards quality, although we don't think we're going to see a recession this year. We still want to make sure that we're up in quality in case as growth slows, we do experience any challenges. So quality, particularly in the large cap space within the US, but it is a very highly concentrated index with about a third of the index in the top 10 stocks. So think about a bit of diversification there. If you want to own the Mag 7, great, but think about diversification even with the Mag 7, being active there. Remember that we used to call them the FANG stocks, so we keep changing the name and assuming it's the same stuff, but it's slightly different constituencies. And then think about some of that portfolio drift that happened in portfolios last year on the equity side. I'm not saying that we need to be 50-50 value versus growth, but trying to make sure we're in slightly better balance given the market moves last year, I think would be a prudent move.
Okay, I'm coming your way now, Matt. Best ETF idea given a rate cut outlook as well as a soft landing.
Yeah, so I'm going to go into equities, right? Because the underpinnings of this thesis is that we still have strong economic growth, right? Supportive labor markets, the consumer remains resilient, and we have lower financing rates. And I think what that sets up to me is home builders, right? So XHB is our fund in that space. We really like home builders because if you have lower rates, that's going to unlock some of the supply in the housing market. We've already seen mortgage applications with rates coming down, hitting 4-month highs. You also have, from a fundamental sentiment perspective, last quarter, home builder stocks, more than 80% surprise to the upside. It beat expectations by 8.5%. Both of those measures are greater than what the broader market did. Also, since the end of last quarter, we've started to see their earnings per share estimates for full year 2024 be revised higher by 4 percentage points, which is far greater than what the market is doing, considering they've had their revisions lowered. So we really like home builders based on this idea that a soft landing means that the consumer remains intact. We still saw really strong GDP numbers this most recent quarter. Retail sales can continue to go higher. In the labor market, 80% of the population is employed. If you look at that employment to population ratio, that number was above 80% every single month in 2023. That hadn't happened since 2000. So we really like home builders with XHB.
Thank you. And by the way, let's say you end this webinar and you forget the ticker symbol. Not a problem. Go to etfcentral.com. You can go into the toolbar. You don't have to remember the symbol. Just type in mortgage. You'll find all the mortgage ETF. Type in home builder. You'll find all the home builder ETFs. So it's built for you to find all the US listed ETFs, all for free, available at etfcentral.com. We had a live question come in. I want to try and hit that one now because I think it's perfect timing. Meera, if I could come to you, the question reads, does the size of the US debt have any impact on the bond market right now?
I do think it's going to have a long-term impact on the bond market. And if we think about what happened in September and October of last year, where we saw yields move higher during the period where there was a tussle over a potential government shutdown, and when it looked like Treasury issuance was going to be more than the market expected, I don't think those issues are going to go away. Yes, recently what we've heard from the Treasury is perhaps issuance is going to be a little bit softer than initial expectations, but nonetheless, we are looking at 5 to 7% deficits for the next 10 years, period. And generally what we see is really a 3% or so deficit over the last 50 years. So this means a lot of treasuries coming to market. And unfortunately with the Fed, as they slow down on their quantitative tightening, yes, this alleviates some of that pressure a bit, but they are still not looking to be a big buyer in the markets as they had been for the last 10 to 15 years. So I think that what this does is create a bit more of a floor on yields overall in terms of how much they can come down, because investors do want some compensation, given the fact that there is a lot of polarization politically in the US. It seems like we continue to have battles over funding the government and getting really close to the debt ceiling. We've had those the debt rating downgrades as well. So this is something on investors' minds, particularly at a time when you can get yield in other parts of the world. So I think that investors want to be a little bit more globally diversified when we think about the longer end of the curve. And again, some of these debt challenges are going to create a bit of a floor on how much yields can come down over time.
Thank you, and thanks for the question. Keep them coming in. David, I want to slide over to you for a moment. We've talked about it briefly, this idea of geopolitical risks in the marketplace, but sum that up for us. How concerned should we be? Should advisors be adjusting their portfolios? What are your thoughts right now?
Yeah, I mean that's a great question. I mean the thing about geopolitical risk is that these things are an exogenous shock, right? And so by definition, you don't necessarily see them coming. In fact, you don't see them coming, or else they wouldn't be a shock in the first place. So the I think one of the things that we can look at is that what would the impact of the shock be, and how is your portfolio protected against it? And a lot of ways to do that is through either like a buffer strategy. So for instance, if you believe, as we tend to do, that at the index level equities look rather expensive, our preference is of course looking within the index for quality and finding those lovable laggards. But if you believe that the index as a whole is, either fairly valued or a little bit rich even, then it makes sense to look for some ways to provide yourself downside protection. And right now, that downside protection is pretty cheap, right? Equity volatility is, is pretty low. Implied volatility is pretty low, so it is fairly cheap to provide yourself some of this downside protection. We ourselves very much like strategies that have, for instance, like an S&P 500 with a buffer strategy with some of this downside protection, in which the investor gives up some of the potential upside, which we don't necessarily think is going to come, in exchange for some downside buffer protection. And we do offer ETFs like that. One of the ones that we have is our IVVM, which is our 5% moderate buffer on an S&P 500 exposure.
Matt, if I could come over to you for a second, just because I'm getting some follow-up live questions about geopolitical risks, and some of them are a little bit more focused on the international market. So could you talk a little bit how you're advising your clients to navigate those risks across the international markets? And let's just put it out there, is 2024 the year where, I don't know, the U.S. investor should be thinking and focusing on other international economies?
So it's kind of funny, right? Everyone sort of calls for international to be the year for international, and everyone ends up like Charlie Brown in the football. The U.S. continues to sort of just dominate year over year. I think it's probably going to be the same thing in 2024. If we just look at some of the broad-based economic growth, I know the EU barely, averted a recession with some of their most recent GDP print, but it still wasn't robust. The U.S. continues to have strong GDP numbers, obviously a little bit below trend. But on an earnings basis, when we look out from a developed market, the U.S. is one of the few developed markets that have projected double-digit earnings growth. I do get that valuations are extended, but they do have strong price momentum. So if you look at those sort of true three quant factors of value, momentum, and sentiment, 2 out of the 3 have an arrow pointing up for the U.S. Outside the U.S., it's a little bit more challenged and a little bit more mixed. I think what we're seeing is, we want to be overweight the U.S., right? I mean, I think also just strategically, you should have the international as diversification. Not saying to not have it. I'm just saying more tactically what we might be doing in our portfolios, going overweight the U.S. Where are we going to be underweight? The EU. Earnings quality is not as strong. Price momentum is not there. Valuations are sort of mixed as well. For Japan, sort of a neutral stance. Quality factors are okay. Sentiment is a little bit mixed. Valuations are not attractive. I think so that needs to be sort of put into context. One area to keep an eye on is emerging markets. Sort of headline political sentiment is not great. Valuations are, however, and we're starting to see a little pickup in earnings sentiment from that perspective. You are seeing an acceleration of inflation there too, based on food and auto overall inflation statistics. So when we're thinking of it from a tactical asset allocation perspective, how we're positioned right now is maintaining an overweight bias to the U.S. and then also a little bit overweight to EM and funding that out of the EU.
Meera, let's stay on the global markets because we're getting a lot of questions, and I'm trying to kind of summarize them in. So maybe I'll ask it broadly and let you sort of tackle some of the nuances that are in. Thank you again for all the questions. What's JPMorgan's focus right now when you start to look out past the U.S. market? How are you looking at global markets, and do you have expectations for 2024?
We are somewhat in line with what Matt was saying in terms of really gearing towards the U.S. in terms of quality. But I do think this is a year where at least the international markets can be a little bit more competitive. And many of the international markets last year also had some pretty strong double-digit returns and were competitive with the U.S. So when we think about it from a diversification standpoint, as those markets are a little bit more competitive, you do have a little bit more options for other areas in a portfolio. I would say that areas like China probably going to continue to struggle. The property issues that they are dealing with there is likely going to be a 3 to 5 year issue where they have to work through that. They're taking the short-term pain for the long-term gain to make sure that economy really in and of itself delevers properly and comes back into better balance. So I think the steps are in motion there, but it could take a little while before we see the markets take off. Maybe you see a bit of a sentiment rally there, but that is an area where we've actually seen clients interested in areas like India, where you're still looking for international growth in a portfolio. And that is one of the areas with some of the strongest growth rates in the world, while having some pretty favorable demographics for the long run when we think about the working age population, and making investments in things like industrial policy, whether it's infrastructure or digital infrastructure. So we do see some upside there. From a valuation perspective, sometimes can be a little bit more expensive, but the return on equity is pretty reasonable there, and therefore it's perhaps a little bit expensive for a reason. And then, agree with the comments on Europe. It's just experiencing some challenges again in terms of growth. I think that there are areas when we think about themes where Europe looks good. If we look at renewables or luxury goods or biotech, but very much with international investing, it's being active and kind of narrowing the focus to what some of those themes are. So where we would maybe pull back a little bit on Europe, we would do that in favor of increasing allocation to Japan, an area where it is also reaching its all-time highs again after about 30 years, but at much lower valuations, with a nice roadway here on out for some of that corporate governance reform to actually improve some of the dynamics within the equity market, which you're starting to see when you look at profit margins, buybacks, et cetera. So it's tweaking some of those regional exposures, but also honing in on some of those themes that have really been producing.
Okay, thank you. It is time for our next ETF roundtable question. So this one is, we want to look for your top ETF idea to manage risk across global economies. Matt, could I start with you?
Yeah, so from that perspective, I sort of really like real assets. So if you look at, what we expect from a macro perspective, there could be some more macro volatility. Inflation continues to be okay, but we would like to sort of own some real assets because many portfolios are structurally overweight growth equities and then nominal bonds. So a real asset sector rotation portfolio that owns some natural resource equities, some commodity producers, some direct commodities as well, in addition to gold, and then inflation-linked bonds, real estate, and things along those lines. You get a real asset portfolio that can help potentially sort of mitigate some of the macro noise in the marketplace. You can, be a little bit less correlated to equity markets and have more of a real return outside of fixed income. So we also, and obviously that's going to be actively managed. So that's RLY for our firm, our multi-asset real return ETF. And I think it can add some potential benefits in a market where you do have a lot of different sort of macro trends impacting broad-based equities, but also fixed income.
Okay, coming to you, Meera. Top investment strategies to manage risk across the global economies?
Ultimately, again, it's an up in quality move in terms of stocks and bonds. So when I think about the stock market, again, U.S. has a lot of quality, large cap in particular. When I think about the bond market, adding a little bit of duration for protection. And then even in the shorter duration space, across the curve, it's really about thinking higher quality, whether it's municipals, high quality investment grade. I know that clients are certainly more interested in high yield these days, and we do want to be a little bit careful because that is an area that is expensive, even though you can pick up some pretty good income. But you're actually seeing that some of the highest quality high yield names are moving up to the investment grade index, so you can find a nice middle ground there. And then some of the, again, higher quality asset-backed securities as well. So it's all about quality across the board to really preserve portfolios from some of these risks.
All right, David, your turn. Top ETF to manage risk across global economies.
Yeah, I find myself agreeing with Meera on almost everything she said this afternoon. Yeah, it is a question of quality. I think that and that is true. You want to look for the quality characteristics, and for us, that looks like free cash flow. Good free cash flow as a percentage of your net income. It also means to have low earnings variability, and it also means low operating leverage. And we think these are the sorts of companies and companies and sectors and industries with that style are going to outperform, in our view, in 2024. It also means, it does mean being up in quality in fixed income. We'd like to be much more in investment grade. And again, like Meera said, you can, earn a very good coupon and income in high yield, but really a lot of that is coming from the risk-free component of it. You're not getting a lot of spread, a lot of compensation for default risk. And we are going to have a slowdown. We think in the second half of this year, we think it's going to be a modest slowdown, but the risk is that it could be more, and we have to wait and see how the data play out. We don't think that you're getting enough compensation there in the high yield spread to justify a real allocation towards high yield. But I think the number one way in which you're going to do this is not just like, I'm sorry. I was just going to say the number one way is just to be diversified. I think, in our view, that I know there's been a lot of interest in international exposures. We also very much like Japan. We like emerging markets outside of China, like an EMXC, emerging markets ex-China.
Thank you. And as a reminder, etfcentral.com, you can type in the ticker symbols, learn all about these ETFs. Meera, I want to talk a little bit, maybe in a reverse way. We've talked about the Fed. We've talked about the U.S. bond issuance. We've talked about managing geopolitical risks. Are there factors out there that you're looking at that maybe we haven't even brought up in this discussion so far?
We've talked about a lot of risks already. Recession is not completely off the table. What we're seeing from some of the headlines is that there is still some concern about some of the regional banks and commercial real estate. And it's interesting because I think all of these things are things we talk about pretty regularly because they continue to come up. And yet, if we think about the sequence of events last year, we had the regional banking crisis. We had a near collision with the debt ceiling, the debt downgrade, almost having a government shutdown, geopolitical risks. And yet it was a year when we avoided recession, inflation came down, and the Fed pivoted. So we did get a trifecta of good news, and it was the news that mattered. So we were still up 25% last year. So I think that we should also consider that there are upside risks to be had. And despite all of the negative things that happened last year, we had an upside case where markets did extraordinarily well and actually defying all expectations, growth accelerated in the face of the fastest Fed hiking cycle in history. So I actually do think we should think a little bit more balanced about the risk, because one of the biggest risks for portfolios in the long run is that people are too risk averse, they're too nervous about all the downside, and then they try to be too defensive and conservative in portfolios and risk in the long run that shortfall in portfolios that they didn't grow their assets enough to meet their ultimate investment objectives. And that is really, to me, one of the silent killers of the portfolio, not being optimistic enough when we think about some of these upside risks.
This was a great question. Thank you for whoever sent it in. I want to stay on it if I could. So just a heads up, Matt, because I'm going to go to David next. But David, we talked about a number of different risks out there, but is there a trend or something out there that we haven't talked about that you're actually focused on?
Yeah, I mean, I think, for us, I think a lot of people have really become very concentrated in some of their exposures, and this made sense because of how markets performed in 2023. We have many of the investors we speak to have very large cash positions, and I think they having a very large cash position in 2024 sets you up for missing out on what could be like one of the better years for fixed income. This is the time, we think, the period between the last hike and the first cut, that you need to extend out of cash and further out the yield curve and take advantage of some of the still, attractive current yields that you can get in that sort of 3 to 7 year part of the yield curve. I do think as well that there is some tendency for people to performers that have done very well. So a lot of times this is technology, and even a very narrow slice of technology, right? A lot of times it's just one or two names. It's no longer even just the Magnificent Seven, where really this year has been very much a story of really more like three names that has been driving the performance of the index as a whole. I think there is a risk in that, and I think what people should do, it would be prudent for them to do, would be to look at what we're calling the lovable laggards. Look for equities, look for sectors, industries, names that have many of the same characteristics of these high-flying technology stocks, that have good free cash flow, that could have low operating leverage. Look for this, and you'll find better value out there. And I think that is going to probably be what will reward investors in 2024.
Thanks, Matt. I still like this question, so I need to come to you. Are there trends that we haven't talked about that maybe you and your teams are looking at, focused on, concerned about?
Yeah, so every year we write an article, and it's on ssga.com right now. It's the gray swans, and there's 6 of them. One of them is around regulation. And I think that is somewhat of a tail risk, right? A gray swan is not a black swan. It's a gray swan. It's not his left tail move, but it's close enough. And I think one of the things that we wrote in there, just to keep an eye on, is that given the concentration of market power, given the concentration of earnings growth, the idea of antitrust could become a topic on both the campaign trail and also within the halls of Congress. You start to see this on a global basis. You have the EU Digital Market Act coming online in 2024. You saw Apple being fined for some of their prohibitive efforts around their search engines and their app stores. You saw some antitrust discussions around Amazon and iRobot. So this could be something that actually impacts the sectoral leadership that we've seen in 2023, where it's been these mega cap growth, tech-related sectors powering the market. And so the impact for investors for this gray swan would be to thinking about it a little bit differently and maybe own a little bit of value, to think about how to broaden your sectoral positions. And that could be something that's more cyclically oriented, like real estate, which could also get a boost from the decline in rates and the ongoing soft economy, where, again, real estate's not just all commercial real estate. There's still a lot of consumer REITs out there. And I know that was also one of our big surprises for this year, is that real estate does better than most think. So one of the risks that is sort of lurking in the background is this idea of regulation upending the Magnificent Seven and maybe making them, I don't know what the good metaphor would be for 8, but all of a sudden a company gets split up or they aren't able to acquire somebody. And I think that can have an impact on market sentiment, but also sectoral leadership.
David, I want to come back to you. Your team focuses on ETF flows. I know you dig into those. You look for trends and ultimately investor sentiment. What do the flows look like right now, and how does that sort of lead into the sentiment you think is out there?
Yeah, I think, one of the surprising things for us so far this year, and of course the year is really just beginning, but has been the dramatic move towards active ETFs and inflows into active ETFs. It's something that has been a long time in coming, right? I think active ETFs are really only 7% of the AUM of the ETF universe, but the flows have almost been equal to the index and passive flows, the flows into active ETFs so far this year. And that's an interesting development, and very much in line with what we've been talking about this afternoon, is that there are probably going to be opportunities within the market, but you really, not so much at the index level. You have to dig down, find the name, the industry, and sector. And so, for instance, in fixed income, we've talked about how much we like mortgage-backed securities, but there's a wide variety of mortgage-backed securities. There's you can go up in coupon, down in coupon. You can have different vintages, and that's something that an active manager can choose, and it's probably easier to then get those advantages through an active strategy and an active ETF. So, for instance, we do have an active ETF like that, BINC, which is run by Rick Reeder, who is one of our perhaps better known portfolio managers, and so he's able to go and take a look at different parts of the fixed income universe, and not just like sectors or types of bonds, but actually choose individual bonds and individual vintages. that he prefers. And so, I think that's one of the reasons why we have seen this inflow into active management.
Matt, anything to add when you start to try and read the tea leaves on investor sentiment and fund flows?
Yeah, so obviously January just ended. From a market sentiment perspective, if we look at things like rolling 3-month flow differential between equities and fixed income, that differential is 121 billion. So that's still positioning in the 90th percentile historically, and indicates risk on and sort of risk being taken. And I think also when you unpack the fixed income flows at the sector level, we've seen $40 billion go into credit-related ETFs, so high yield, investment-grade corporates, senior loans, with $16 billion coming out of the ultra-short duration government bond ETFs. So a little bit of a re-risking there of going out of cash and going into credit. And I think that makes a little bit of sense if you think the soft landing is going to happen. And there could be some volatility. Owning high yield and credit is an implicit equity bias with lesser volatility that pays you a 7% coupon to wait it out, sort of threading the needle of a soft landing. So those are the two big things, that you still have a risk on positioning, you still have a preference for credit within fixed income. And then on the equity side, diving a little bit into it, growth ETFs had done quite well in January, and actually had their 12th consecutive month with inflows. So in a market where growth may be questioned, buy growth has been the tactic, and that's what we saw in the flow so far.
Thank you. I'm looking at the clock and realizing we're almost out of time here. Meera, I want to give you the floor. We covered a lot, but do you have any final comments, whether it's with respect to any of the other pieces we covered or fund flows you're seeing right now?
Sure. I want to pick up on something that David said, which was at the very beginning about stepping out of cash. What we saw last year coming into the year with all of these bearish expectations about recession, us included, anticipating one of the most widely forecasted recessions that didn't happen, clients felt the most comfortable being in cash and expected to earn 5%. And they did. Cash earned 5.1% last year, and it was the best return for cash since the year 2000. So a multi-decade bonus for clients there. Until they looked at the rest of the market, and aggregate fixed income was down for most of the year until the end when rates dropped and fixed income beat out cash. Whether you like international, developed, US, small, large, mid, value, growth, all of that did better than cash as well. And the sort of humble, diversified portfolio, which was very humbled the prior year, was up 14.1%, so almost triple what you got from cash. So don't fall into the trap of the illusion of safety from cash and let some of the different headlines and risks paralyze you, because you can still, with diversification based on a number of different strategies and approaches that all three of us have mentioned today, find ways to capture upside, protect on the downside without foregoing longer term growth in a portfolio.
Thank you so much. For those that asked questions and we weren't able to get to them, I apologize. We will reach out directly and try and address one. For Matt, Meera, David, I just want to say thank you so much for being here to share your time and insights with us. We also had a number of questions about was this recorded? The answer is yes. Where will it be available for replay so you could share it with your colleagues? It'll all be available at etfcentral.com. I want to thank everyone for joining us for the latest ETF educational webinar brought to you by the New York Stock Exchange, the home of ETFs. Please reach out with any updates, follow-up, or if you have suggestions for an upcoming webinar, we'd love to hear it. You can find it all through the ETF team here at the New York Stock Exchange. Thanks again for your time. Stay safe. We'll talk to you soon.